Hi everyone, so today we're going to be doing a little bit of a different video. I'm with Dom again, and we are going to be doing a new series called Investor Profiles. So these are for super investors, and recently a fund manager that's been around for quite a while, his name's Hohn, has been in the news. So Dom is going to get into his background and why he's in the news and what's happening in that world, and then I'm going to be covering his investment philosophy and what he's currently holding, the stocks that he's picking. All right, Dom, whenever you're ready.
All right, can you see my screen?
Yeah, perfect.
Cool. So today we're talking about Sir Christopher Anthony Hohn. So just a little bit of background about him. He's a British billionaire hedge fund manager. He established TCI, which is the Children's Investment Fund Management, and it's essentially a fund that's focused on value-based investing. It says initially the fund's profits were dedicated to the Children's Investment Fund Foundation, a charity aimed at improving the lives of impoverished children in developing countries. And then it says that Hohn is a recognized activist investor with a strong background in finance and education. He graduated with a first class honors in accounting and business economics from the University of Southampton and later earned an MBA from Harvard Business School, graduating as a Baker Scholar. So as you can see, pretty smart guy. Definitely got a lot of education under the belt. Started a pretty impressive fund. So we're going to take a little bit more of a deep dive and kind of some of the success of his fund and some recent news about it.
Oh.
So here we have an article about a week old now, so pretty recent. Kind of talks about some of the accomplishments that the fund's gone through. So first thing, pretty huge if I had to be honest. It says the firm generated 18.9 billion in gains for investors in 2025, the
Wow.
biggest annual haul ever, according to a just released survey. Pretty impressive, especially for a fund that it states back in the original bio it was founded in 2003. So it's not like a crazy old fund, but it's not exactly a new fund. But still, very impressive number. You don't see that very often. Again, just basically broke a record, which is awesome. I also wanted to mention that their fund is it had the largest gain in 2025, like I mentioned, and that over the past 3 years, it's made 40 billion net of fees for its investors, so it's been pretty profitable for them. Uh, they also did mention that uh, they put the TCF fifth in this year's ranking for the net gains since inception with a total of 68.4 billion. So basically, they had like a list of total gains, and they jumped from 14th to fifth place in only 3 years. Again, very impressive. So essentially, starting from the bottom in 2003 to becoming top five in what 21 years,
Yeah.
pretty good. So as we can see, like the fund has been very successful. It definitely has had bad times like everybody else, but it in a general sense, it's been extremely good. And honestly, it's pretty hard to do that. Like we mentioned before, the guy has a lot of smarts under the belt from all his degrees and everything, so he's been doing it for a while. But it's just a immensely successful fund for how long it's been and all that. And it's definitely something worthy of looking into more. So I'll let Matt take over now, kind of go into his investing philosophy and kind of see how they reached these milestones and things like that.
Okay. Thank you, Dom. I appreciate it.
Yeah.
All right. So, like Dom was saying, he had record-breaking profits, but we need to find out how did he come about this, what he was thinking, all of these things. Now, keep in mind this article. This is from Substack, but it's a little bit old. Even this is from May 20th of 2025, so last year and a couple months ago, before they even released this $19 billion gain. And even then, Hohn's investing philosophy has delivered 18% annual returns and this was as of 2022. So this was twice the return of this S&P 500, which is incredible. And just to go over what he does is usually his average holding period is about 8 years. Okay, and this is not typical for hedge fund managers. You're usually high frequency traders. They're certainly less than a year or just about a year, and that's it. And it even says it well above the industry average of less than a year. Yeah, so exactly. That average is even pulled down by newer positions. Some holdings go back 13 years. So again, excellent. And we're going to get into like what he's currently holding so people don't feel misaligned or anything. He relies heavily on his intuition, but not in a vague or mystical sense. He determines trustworthiness and recognizes patterns. Okay, great. And he has a very strict criteria of how he picks these stocks. So he considers growth to be less important than the moat. So he always talks about like Buffett talks about. He always talks about the competitive moat of a business almost being a monopoly-like business. Obviously, think of Alphabet, Google, or Alphabet, Microsoft, Apple, those types of companies, Coca-Cola, Buffett-like companies. Substitution kills a business outright. Competition erodes returns. A strong moat protects against both. Very good examples. He gives several examples. The first is irreplaceable physical assets like airports, toll roads, telecom towers, which are local monopolies. You can't realistically build a second airport next to existing one. Exactly. That's exactly right. Now, he also looks for intellectual property, IP. A good example is aircraft engines. The technology is deeply complex and the supply chain entrenched. So probably like Lockheed Martin, they have a lot of IP. They have a lot of patents for aircraft vehicles. I believe Dom and I actually have covered those types of companies as well before, like defense contractor companies. They have those types of patents that no one else could get or no one else could build. So again, another edge that we want to understand. So just to take a look, but Hohn doesn't limit himself to physical assets or aviation. He also looks for most in installed base, network effects, switching costs, and brands. With an installed base, Microsoft is able to shield returns. When Zoom gained popularity, Microsoft simply bundled Teams with its software suite. It didn't even need to be better than Zoom, just good enough and part of the package. And network effects come up briefly as he mentions Visa and Meta. Switching costs matter most in mission-critical software. As for brands. So again, huge competitive advantage. Companies, once Hohn is confident a company has a wide moat, he asks the question, is this product or service essential? And of course, it matters because that's what happens when there's pricing power. So they're near like a monopoly. They could charge their customers essentially whatever they want, and it always increases. Customers keep coming back because they need it. Exactly. Like Apple with the iPhone, they always increase the prices because people need the new iPhone, right? Most companies can't raise prices above inflation, only a special group of super companies. Okay. And what Hohn avoids. So he made this list during the 2007-2008 financial crisis, which I was actually reading from ChatGPT, but just to give it some nuance here. But he loves to avoid banks. Banks is a big one. He does not like to invest in any banks, autos, retail, insurance, commodities, asset managers, despite being him one itself, fossil fuels, airlines, and media, and ad agencies. These are generally cyclical industries, super cyclical industries, or they're highly unstable industries. They're unpredictable a lot of the times with not great moats. They're completely different industries, but the problems are the same, too competitive and too exposed to disruption. Exactly. That said, his view isn't absolute. Hohn does own Alphabet, which he admits it's his riskiest position because of the AI threat. That's why he's saying that. And we're going to see here in a second why. And lastly, on valuation. Hohn doesn't start with valuation. He looks at it once he's convinced the business has high barriers to entry. If he only looks at it once he's convinced the business has a high barriers to entry. If the moat is strong enough, then he'll dig deeper, but by making reference checks, talking to competitors, and assessing management. Valuation models come later. He does ultimately use traditional methods, including multiples and DCFs, which we've done, but only after the qualitative work is done. The real advantage, according to Hohn, is long-termism. The longer you can look out, the more a business is worth. Extend the forecast period, and you extend the runway for excess returns. So exactly right. And I'm glad he said it. So, and that's pretty much it with this one. Now, the next thing I want to cover is what he's currently holding. So his big gain of why he made the $19 billion is because of GE. And this is not General Electric traditional. This is GE, their aerospace division, which was spun off. And he owned shares in that. And in 2023, because you could see the first quarter that was owned in the year, Q1 of 2023, which the estimated average price he paid for was $77, and now it's $300, right? And this is from September of last year, keep in mind. So it's a little bit old, but this is the newest public information that's available now. Visa, he was increasing his share count. He owned that since 2019. Again, he's super long-term bullish on that. Microsoft, he was selling off a little bit. We have Moody's here. We have S&P GI. So that's a ratings agency company along with Moody's. So two ratings agents companies. CP, which is Canadian Pacific. That is a railroad company. He's been selling that off. You have Google, of course. He's been selling that off. That's had quite a rally. CNI is also another railroad company. He's been selling that off. FER, I believe, is an international company, and he sold all of the rest of Google stocks because Google has GOOG and then GOOGL, so a little bit different there. But altogether, yeah, I mean, this looks like obviously a very good portfolio. He did very well with the GE pick. It more than tripled, or more, yeah, yeah, more than tripled. So congrats on to him. He certainly deserves the success that he got. And Dom, is there anything else you wanted to add?
Not much, but just yeah, a very impressive history for how long he's been in it compared to like legacy hedge funds that have been in it for like, 50, 40 years. So
Yeah,
kudos to him.
yeah, exactly. All right, Dom, thank you. I appreciate it. Have a great day.
Yep, thank you.